welcome everyone. It is an enormous pleasure to have so many people join us for the second time around. So thank you very much for signing up and turning up. And thank you to those hopefully listening to the very exciting recording, which will have lots of great editing tricks in it. Yes, so we're here to talk a little bit about the follow-up to our previous webinar back in October, which was on CP10/25. And now that we have the supervisory statement and the policy statement published in December, I'm sure you've all given them a read through cover to cover. They're a thrill ride. We're going to talk a little bit about the updates. We're going to talk a little bit about some of the practicalities. I'm going to talk hopefully a little bit about some interesting examples of how we, as two different organizations, I'll introduce in a second, approach those things. So, by way of introduction, so hello, I'm Tom Summers, for those who don't know me. I am one of the directors at SkenarioLabs. So we're an Anglo-Finnish property and real estate and built environment data analytics business. We do work all over Europe with all kinds of banks, insurers, and other types of financial services institutions, as well as with governments. Joining me are my colleagues Eli Kytinen and Iris Saskilati, who are part of our operations team. So Ellie leads on delivery, and if you do end up doing some projects with us, you will undoubtedly get to know Ellie very, very well. And Iris leads on comms and marketing and has made all of this happen. So thank you very much to both of them. And joining us from Red Queen Advisory, we've got Steph Henderson-Begg, who founded it and got everything going and has a tremendous amount of wonderful experience in the financial services industry, particularly around risk, at indeed lenders, regulators, and in the Big Four as well. So a little bit of all sorts. And Erin Thompson, you'll also be hearing from today. Thank you. Who has recently joined Red Queen from the PRA, where she was very heavily involved in looking at setting capital for climate risk, and therefore is absolutely someone who is worth listening to, unlike myself. So if we go on a little bit about who the companies are, I realise I looked at the attendee list this morning and realised that some people wanted to come and talk to us for the first time today, which is great. We are a couple of different organizations. We like talking with each other. We think we're very complementary, but we are very much two separate orgs. As I mentioned, we're a data analytics company. We do an awful lot of work. Particularly, our sweet spot is usually starting with very poor quality data and leaving our clients with much better quality data that they can make decisions with, all around valuations and modeling and energy and all kinds of different things. Whereas the team at Red Queen are much more on the consultancy side, and so they're very much a team of experts with, as you can very much tell from my introduction, tremendous experience from around the sector to assist organizations with risk, with ICAPs and ILAPs, and all of those sorts of things. So if you do want to reach out to either of us, do feel free. So if I go to the next slide, what we'll be talking about today, very, very briefly for you. So, of course, we're going to be talking about some of the changes between the previous publications and the more recent ones in December. So what's changed and what are the things you need to think about with regard to that. I'm going to be talking a little bit about data because I'm a huge nerd, as well as the approaches that you need to take to it. So how you can really think about it, how it can be compliant. I'll be also then talking a little bit about risk fundamentals. So some of the feedback we got from the last webinar, which was great, was all about, okay, great, you talk about reverse stress testing. Don't worry, I won't do that again. But actually, can we maybe take this back a point or two into something that makes a bit more sense for those of us coming to climate and transition risk for the first time? We're going to be talking a little bit about proportionality, major question, major factor in the recent publications. And then Steph and Erin will be talking about some of the practical approaches, particularly to controls, a little bit of a section on the ICAP and ILAP, and then a very lovely and very, very helpful guide to getting yourself towards that 3rd of June deadline. And then I'm hoping that we'll have 10 minutes for questions at the end as well. So please stick around and you can see if we actually do know what we're talking about. So I'll hand over.
Thanks, Tom. So hello, everyone. When we spoke to you last time, it was still in consultation, the updates to the supervisory statement. But of course, as Tom's already mentioned, we've had that policy statement now, and there's been a couple of changes that's just worth bringing to your attention. So first is that rather than having to be fully compliant within 6 months, as they seem to imply with the initial CP, it's now 6 months to get to a point of having a gap analysis and a plan as to how you're going to reach compliance. So that's 3rd of June that you need to have that ready by. And I think there is an expectation that supervision could be asking it any time after that. So make sure you've got something to share and have conversations with about thereafter. The other key change is they've added litigation risk as a subset of physical and transition risks, and brought out some more information around how you might think about that coming through in the scenario analysis that you do. There's been some clarification around how governance and risk management expectations for climate risk can be integrated within existing frameworks rather than having to build anything afresh. And they've also clarified that data uncertainty should be understood, and there's no need to actually quantify it at this stage, as could have been read into the first CP. There's also some more information on climate scenario analysis, particularly around that proportionality perspective. And they have removed the need for reverse stress across all firms, instead saying that it's something that you should consider. And finally, they've just been a little bit more clear around the timeframes and how you expect to see stress testing for climate risk aligned with ICAP, ILAP, and your strategic planning pieces. But all of these things we're going to talk about in a little bit more detail as we go through. Erin, you're on mute.
I'm on mute. Beginner's mistake. Sorry. Okay. So climate risk characteristics, just sort of to touch on here, and sort of, where the PRA is coming from it, and I suppose where we expect them to be coming from it, is, climate risk is different to most of the other economic risks that have been modelled or mitigated, in that we know it's coming, but there's not much history and data on what's happened before that can be used. We know it's going to be systemic and it will impact everyone in some ways, and we know it's foreseeable, but it's actually uncertain around how it's going to play out, which makes it a bit more tricky as well. And there's also the act now, sort of point. If actions are taken now, the impacts will probably still be there, but be lessened. And that's something that firms will have to think into their risk assessments as well. So I think this is why it's been pulled out. It's a total different sort of risk to think about than other sort of economic risks that firms have had to think about for a long time.
I think that's really important, actually, because most of the time in stress testing, you're looking at historical events, things that have actually happened to back up your assumptions. And this is where it's so different, because there is no information to draw upon. And so management judgment becomes far more important. So just to give a reminder around some of the updates around governance in particular, I mean, there is significantly more emphasis in this updated supervisory statement around the role of senior management and the board. All firms need to have an SMF that is designated for oversight and responsibility of climate-associated risks. The board need to have appropriate training and involvement in continuous oversight of climate risks. One of the key first activities for firms to undertake is a risk assessment, and we're going to give you some hints and tips on how to do that a little bit later. The risk assessment needs to drive how you then think about policies, procedures, 3 lines of defence set up, monitoring, reporting, and really that risk assessment to quantify and to help think about the framework that you need to manage these risks. It feeds into the climate scenario analysis. So firms need to be thinking about different climate scenarios for different types of climate associated risks. The board needs to be involved in approving those scenarios, understanding the limitations, and thinking about how they link into the risk assessment. From this, it should enable you to think more about risk appetites. So how can you set limits or targets, at least in the short term, around some of these climate risks that you're exposed to, and not just at a kind of a top of firm perspective, but really down into business units and thinking about how this impacts your outsourced relationships as well as your product offering and your customers. And finally, from a board perspective, all of this needs to link into business planning. So you need to be thinking about, well, how does that change the long-term strategy? Can we demonstrate that there is a clear link between the risk assessment, the climate scenario analysis, and the risk appetite that is informing our strategic position and how we're evolving the business over a period of time?
Okay, so we've broken down here for you sort of what firms need to do, because a supervisory statement is effective immediately, but you do have 6 months to create sort of a gap analysis and a credible plan for how you're going to implement it, and you've got to do this by the 3rd of June. And we've broken it down here into sort of a step 1 and step 2. And it's not the case that you need to get step 1 done by the 3rd of June. Step 1 and step 2 are sort of ongoing requirements. And there's an expectation that firms will keep doing this and keep updating this. But it is sort of broken down into the risk identification and assessment, and then also applying the appropriate risk management tools and response. So for the risk identification, what firms should be doing is sort of thinking about all the kind of different climate risks it could be exposed to through the various transmission channels, property damage, price shifts, etc. Think outside the box a bit for this. And then the firm's got to make an assessment of the materiality of the risks, like whether it could have a material financial impact. And then for the material risks, not the ones that are less material, these should be captured in the firm's risk register. And this should be reported to the board. And the board should then also ensure that all the material risks are captured in the risk appetite. And you've got a risk appetite level for each one. And then this also should be reviewed by the board. And you should think about timings for when the board reviews this register and thinks about the risk appetite again. I know we're going to touch on proportionate sophistication later on, so I won't say too much here, but really just in terms of the risk identification and assessment, you can use, or smaller firms with less material risks can use simpler tools, but you've got to understand the limitations of what you're using and what it's not showing you. And given there's been sort of this lack of historical data, a big tool in doing the risk identification and assessment is actually the climate scenario analysis that we'll come on to as well. And it's very much forward-looking. So we'll talk about that a bit in a minute. But moving on to the step 2, which is the appropriate risk management and tools. So once you sort of know what your material risks are, you can establish, your risk management and your oversight mechanisms. And we'll touch on these again, but these could be things like risk controls, or collecting more data on this, or setting limits on how much lending we do in this area, etc. For any risks that aren't mitigated, and there will be a material financial risk going forward, they should be thought about in the ICAP and potentially capitalized in the ICAP as well. And again, the risk management tools should be proportionate to the risk and the sophistication of your firm as well. And just to emphasize again, this is all an ongoing requirement. So you update the risk assessment, the CSA, and the risk management approach on a continuous cycle. So moving on to the next slide. The types of risks you could consider. So you need to think about how the various transmission channels will impact the sort of existing risk types you probably already think about within your firm. And the transmission channels, they can relate to the firm itself, but they can also relate to your clients, your counterparties, your suppliers, your investors. And we've got some examples, here, like, for households, who might be, your clients or who you lend to, loss of income, property damage. For businesses, property damage, stranded assets, business disruption, legal liability as well. And from a broader macroeconomic perspective, you could have shifts in prices, labor market changes, all these things that have longer term financial impacts. And how these sort of fit into the existing risk stripes, they do so in a number of different ways. Credit risk is probably one of the easier ones to think about, particularly, secured lending with collateral. If there's damage to the collateral, then the LGD is probably going to go up. But economic changes, loss of income can also impact on the probability of default as well. And you also might be more affected here if you've got concentration in high risk either sectors or geographies. Market risk as well, how the price of things might change, whether there's price shocks, how returns might be impacted as well, particularly for climate exposed assets. Operational risk, you could really think here around what was to happen if there was an outage because of like a climate event, like there's a flood of a call center or something like that. And it doesn't even have to be within the firm itself. If you've got like a third party supplier and they have an outage, how it could affect the firm. So thinking about that as well. Liquidity risk, this is one, I think this is one that's probably a bit harder to think about, but, it still can be thought about. How do your net cash outflows change if there's a sudden climate risk event? Like, if there's a flood, will lots of your customers suddenly want to access their deposits or draw on extra lines of credit? Think about that. Or there could be sort of, changes in markets that affect your funding plan in the long term. So something to think about. Litigation risk, I mean, we haven't seen a lot in this space yet. I think it's very relevant for insurers, but for banks as well, you might want to think about how your clients could potentially be sued or because of something they've done or haven't done. And a reputational risk is there as well. So, there could be a change in sort of consumer sentiment towards particular companies because of what they've done and haven't done, and you could be exposed to those companies. So that's something to think about as well. Some of the potential climate scenarios, when you think about sort of the physical risks and the transition risks, on the physical side, in the credit risk, as I sort of mentioned, you could have properties flooded, impacting on the borrower's ability to repay or the LGD. Businesses could suffer lower productivity or increased costs because of flooding. The operational risk ones I sort of covered, if there's an outage that affects the ability to sort of deal with customers. Market risk, businesses suffering lower productivity or increased costs because of a climate event. And the transition risks don't relate so much to a climate event happening, but how the world is going to change, how governments are going to change, given the not governments change, but government initiatives are going to change, given the shift to sort of a higher climate. So, on the credit risk side, there could be a loss of key employers in areas due to sort of closing down of certain industries. The government might mandate that compulsory EPC ratings have to be higher for buy-to-let properties. On the operational risk side, some of your vendors could go out of business in the longer term. And on the market risk side, that's where we could see some of those price changes as well for those that have exposures in carbon intensive industries. So moving on to the climate scenario analysis. So I suppose once you sort of know the types of scenario you want to run, you actually have to run the analysis. And I think the PRA's expectations here, the initial assessment that you do to identify the risks will be sort of less mathematical and sophisticated. But when you get to the climate scenario analysis, there is an expectation that it's more granular and quantitative for all of your material risks. Proportionality comes into it again, and I think Tom's going to go into that in a bit more detail later. But if you're a small firm with sort of small risks, you could have sort of primarily narrative-based scenarios and sort of quantify those with expert judgment. But if you're a larger firm or you have a larger risk, you probably really need to use more mathematically sophisticated approaches. The the PRA has said that in doing your scenario analysis, it can be internally or externally developed. Though obviously those with higher risks, there'll be a greater expectation of you sort of understanding this, yourself. Um, and the scenario analysis should be tailored to sort of how it's going to be used. So the frequency, the severity, the time horizon, you'll take a different approach to it in your ICAP and your ILAP than you will for like sort of your longer term business planning and longer term risk management. As Steph said, all this should be understood by the board and it should be subject to regular challenge and review. And what you should be thinking about is a range of sort of plausible scenarios for each of these risks, but probably focus on sort of a likely central case as well. And the PRA has also said is where firms don't yet have reliable data, you should use contingency solutions for now. So you might want to use, proxies, approximations, assumptions, but understand the limitations of these and explain them as well. So I'll hand over to Tom now. I think he'll be able to talk to you more about the kind of data and how you might want to use it in doing this.
Fabulous. Thank you ever so much, Erin. So yes, Erin's done a great explanation there of some of the changes, both things that have, I suppose, remained similar between the previous publication and the newer ones, as well as some of the iterations to it as well. So I'm going to talk a little bit now around some of the practicalities around how you can look to respond to those requirements. So data is a major underlying factor, and I was already introduced as an enormous nerd. This seemed like the only place for me to start, really. One of the really key things here is about understanding where information has come from and understanding both its strengths and its limitations when it comes to decision making. And to do that, here is a framework that we use, as well as one that's compliant with the regs. So effectively looking at very clear understandings of where data is being sourced from, especially when you're pulling it from, for example, open sources, how you're then linking data sets together, a major challenge. And I can tell you this is as much a challenge with the biggest high street banks all around Europe as it is with the smallest building societies that are very locally focused. Getting data well matched is really, really hard. Transforming it. So what that means is effectively taking it from just being data into it being information. So cleansing it, getting rid of all the rubbish, taking out of it the things that are really important to you, validating it, making sure it's right, and then into usage. So making sure it's being utilized and shown and presented in the right way. A way that we like to visualize it at SkenarioLabs is directly stolen from Google, which is the data value chain. So data ingestion, transformation really are, to me, the biggest things that people should be thinking about. So we do a lot of work with machine learning and AI, and that's great. We encourage other people to work with it as well. But the biggest pitfall that we see, be that doing something like this in regulation, or be that looking at implementing really exciting cutting edge things, is that the underlying data hasn't been put together in a good enough way to make that work. Be that in the ingestion, ingesting things that frankly can be potentially misleading or incomplete, or through in the translation. So actually they've not been formatted in a way that's very useful to be used for the specific context. Then everyone likes to focus on the data value add, run your models, look at physical risk, energy and carbon, look at valuation. Obviously, this is the way we do it. And then start thinking about, okay, how do we get that into decision making? How do we financialize it to make it work alongside other things we need to think about? And how actually do we get it into people? How do we ensure the board does understand the data we're putting in front of them? How can we make sure that they can ask serious questions about where it's come from, the veracity of it, and understand the limitations of it? There's always a limitation to data, regardless of what the data is. Now, that can be all kinds of things like fully integrated systems. If anyone has one, let me know. Through to sort of nice, clever automated reports. I'm sure loads of you guys are using things like Tableau, Microsoft Dynamics, and things like that, which is great. Or good old Excel. I don't hate Excel. I actually really love it. And all of those are absolutely valid, but you have to just make sure you've thought about what are we putting into where and why. Can people use it? Can people access it? Can people understand it? This is something that we see as being very important. So fundamentally here, we're talking about assets. Assets are things in places. Typically, I know not everyone here is talking about buildings. I know we have a couple of people in auto lending here, but you'll have to forgive me for this point. But buildings are things made of stuff. which makes it relatively easy to ground truth, i.e., find out is your data right or wrong. But it also means it's very important for you to understand it properly. I always use this example because it's really perfect. I'll get a new one at some point for those of me who've seen me present before. So on the left-hand side, you've got a lovely teaching college of in Cumbria. Then if you were to Google it, you would get that nice little red icon there, which is the postal address. So it's where all the post turns up, and pretty much all geocoding, i.e. finding stuff, is done by the Postal Service, Northern Survey, and therefore you'll find where the post goes. However, what you will notice is that it's rather a large site made up of multiple buildings, quite a substantial portion of which is down a hill at the back, and therefore right next to a river, and therefore very, very high flood risk, which you would not capture unless you understood, okay, what is actually there? How big is it? What's it made of? How's it used? Things like that. These are all relevance. Like ultimately, it's really important to understand assets as being things made of stuff and not just as being points on your lovely Excel spreadsheet. So the way we understand buildings, and we can talk about this with people if you'd like to another time, is basically to figure out using our lovely models effectively where the gaps in data. Always look at effectively what something is made of, how old it is, how it's used, the environment, and all of those things underpin models that you can then go and do stuff like valuation, looking at energy and carbon intensity and retrofit options, and of course, what we're talking about today, risk. So I really do stress this isn't as hard as sometimes it can look, but it is about understanding what are these things that we are financing. So physical risks. I won't go over this slide too much because I think it's been covered brilliantly by Erin. Physical risks are the environment happening to your portfolio. So that can be all kinds of things like your acute issues, so events, floods, fires, things like that, or it can be chronic issues, so these very slow changes to the environment, things like temperature, rainfall, and things like that. So you need to look at effectively what is impacting on your building, how likely it is to hit it, what happens to it when it gets hit. So just an example being effectively a small 15th century cottage that's made of wood is going to react very differently to a steel framed warehouse, for example, and the financial impact. So this is particularly key for those of you who are involved in commercial lending. So levels of downtime, that sort of thing. Again, it's all about understanding the context of what are the things actually being impacted here. And of course, how can that impact on you? Naturally, on collateral value, both in the short and longer term. Talk about that shortly. And additionally, in terms of looking at the levels of portfolio impact, so we'll talk about sort of concentration risk a little bit later. Ultimately, it's all about going, what's likely to happen where, how's it going to impact on your borrowers, and how is it going to impact potentially on you? And can you think about that and discuss it in senior leadership levels? Oh, I put a list together here. This is largely for those reading through later. There's an enormous number of risks you can use. This is from the European Central Bank, so it's a list we use. Some stuff is really relevant, floods always, subsidence, things like that. Some, like your tropical typhoons, possibly slightly less for those of you with UK portfolios, which I think is all of you. But it's worth being aware that it's always worth having a think about and saying, no, this isn't relevant to us, rather than just sort of going, oh, we'll look at floods and nothing else. So, right, scenario setting. We get asked about this all the time. This really is, I think, probably the meat of this for a lot of you guys when it comes to what we're talking about. So, how to set scenarios, and also what do they even mean in the first place? So, I'll talk first about climate scenarios, and then the next slide I'm going to talk about timelines. So, you will see probably our CPs being talked about a lot. And you probably go, yeah, it's something about temperature increase. And you're absolutely right. It is something about temperature increase. So RCP scenarios are basically, there's a number of them. There's more than just the three I've put down here. But they're effectively models of what happens as greenhouse gases become further trap heat within the atmosphere, and how much effectively radiation is going to be caused by this increased level of reflection by the atmosphere. I won't go into the physics of it because, well, Ellie is the nuclear physicist, not me. But ultimately, it's about going, how is that then going to change? So ultimately, it looks at the underpinnings of things like rainfall and temperature and things like that, which then translate into changes to flooding and storms and subsidence and all the rest of it. Happy to talk about how that happens if anyone wants to get theory are chewed off for an hour. Three most common, and I typically recommend people go with, are 2.6, 4.5, and 8.5. Talked about briefly, 2.6 is some equivalence of what if we all stop doing very carbon intensive things, and this substantial reduction in carbon intensity from 2020. And you see a relatively low climate impact, still some, but relatively low. 8.5 was a what happens if the world keeps doing the things it was doing, and particularly the growth rates it was seeing in the 90s and 2000s in terms of carbon. And that sees a really very substantial global average temperature increase of over 4 degrees. In some parts of the world, that's pretty catastrophic, but it's worth looking at that in different ways. And then 4.5 is usually a reasonably good mid case. If you want a more aggressive mid case, you can also use CP6 as well. But I did want to explain at least what these are and what they mean, because I see people get sort of almost them thrust on them without really understanding, well, what do these letters mean and what do the numbers mean? So hopefully that's helped a little bit. Time horizons. This, I think, actually is potentially the most important part of setting scenarios, because I think, again, people just get told this is the time sort of horizon you're getting, but you actually can do a lot of work to select it yourselves. And certainly the data from multiple different providers is much more flexible than some people would probably tell you that it is. So ultimately, when you're looking at your risk to, for example, 2030, 2050, whatever it is, you're typically looking at your risk over that period, not the total risk by 2050. And so what you're looking for are sort of these very, very spiky, and we'll come into a second about how we quantify it, scenarios, and being able to measure them over a relevant period to your portfolio and to your strategy. And those things are really important. So we have a note from elsewhere here. So the European Central Bank has recently written to European banks to basically use the exact same forward-looking scenarios that banks are using for their other types of strategic planning. So properly integrating climate risk into business strategy, into lending strategy, as well as into, of course, your existing portfolio as well. So it's worth thinking about, what are the mortgage terms on your book? How do they fit in? When are renewals looking? So you can get your shorter term limits. And then in terms of your longer term, rather than just going, oh yeah, if someone's told us we can have 2050, let's have 2050. Instead, I would suggest looking at your longer term strategies, looking at what you're doing for your ICAPs and things like that, and trying to match, because it's really a fairly straightforward thing for you to do, and it'll make this much, much more valuable to you. So now, how do you actually quantify it? More challenging, but I'll explain this a little bit here. EAL, we talk about EALs a lot, and I feel like I don't always do a good job of explaining them, so I'm going to try and do so here very quickly. EAL is expected annual loss. What expected annual loss is taking that graph on the right-hand side there, which is effectively going, climate events are very spiky. So you can see there huge, great spikes in damage caused by, in this case, floods, but it could be any or all, and looking at effectively how you can annualize that. There's a couple of key things here. So one is that it's clearly not trying to forecast a year's annual losses. That is effectively impossible to do more than maybe a few months out, depending on what weather models you've got. If it was easier to do, then no one would build anything in a place where you're going to get a major climate event. Instead, it's looking for effectively a way in which you can monitor risk in a way that's valuable to you, and you can monitor whether the levels of risk in your portfolio are increasing or decreasing. And then, of course, you can go into the assets and look at which assets or which areas are driving that risk specifically. The thing that's really key to note here, I won't spend ages talking about it, although I can, which is that EAL is a risk metric, and it can be translated through to things like LGD. However, you need to, of course, make some additional assumptions there as well. So you need to look at things like, well, including the amount of outstanding loan, the existing value of the asset. You need to, of course, then look at integrating it with your own lending criteria to go, okay, what levels of risk do we want to assign to this? So it's got to be, again, this relationship between data and decision making that is thoughtful and decisions made in useful, beneficial ways.
Can I just chip in very quickly, Tom?
Also,
Because I see lots of people putting forward in their ICAPs EAL numbers as a potential capital add-on for Pillar 2A. And actually, I think that there's probably a little bit of confusion in the sector around, that EAL number isn't what you, the bank building society, might lose. It's what the cost is to the owner of that property to put damage right.
Yes, and that's absolutely right. And in some ways, therefore, a translation is required, and it can end up looking much sunnier. But also, as we'll come to, particularly when you start looking at concentrations, it can potentially also look quite concerning. But it's really about understanding the data that you're getting and being able to interact with it meaningfully. Thanks, Steph. Really good input. So, notes on insurance, very briefly. Sometimes I end up in meetings and people go, I don't care about this at all because Flood Re covers everything. Those, of course, in the know that Flood Re is coming to an end at some point, and therefore it is always worth looking at insurability, particularly related to EALs. It very much is an insurance metric for those of you with a foot in that side of the world. And so if you're starting to see assets that really risk insurability, you can start to see really substantial degradation to value. Example of that for those wanting to go and have a look would be Florida and California, where you've seen major insurers pull out of those markets due to a mixture of obviously increased climate events as well as the policy response to that. And you've seen valuations in some of those areas drop by sort of 20 to 40%, which is really very dramatic. I'll send you some reading on that later, anyone who wants to check my numbers. The things that Flood Re excludes, which I think people sort of often forget, basically anything that isn't owner occupied. So anything in your buy to let, anything that's commercial, anything new, new being post 2009, which is not that new anymore. And additionally, of course, it doesn't remove your disruption risk and it doesn't remove the potential damage to the actual market value of the asset as well. So just a little asterisk there, worth having a conversation later about it if you'd like to. Transition risks, I'll run through these fairly quickly. I want to be respectful of people's lunchtimes. So effectively, as Erin's already masterfully pointed out, it is the policy response to climate change and how it then impacts on value. So whether that is on things like brown discounting or on inefficient assets, whether it's things like assets being very directly impacted by policy, or whether that's things like, for example, businesses in particular being impacted, and both, of course, that impacting on people's commercial lending portfolios for hard to abate industries, but also on areas that have very high concentrations of certain industries. I always talk about car manufacture, but both very large employers, people like Nissan up in Sunderland, but also absolutely enormous supply chains, which very much are a major part of the local economy. If you start to see those things close, which I don't wish to get political, but they have, both in terms of steel manufacture and car manufacture, you start to see really major market impacts and market risk. So how do you actually measure that? And how can you plan scenarios for it? Overall, my suggestion is look at NGFS. I cannot remember what the acronym stands for, but it is effectively a set of scenarios. I put a QR code on there so you could go to the scenarios. If you want to try and do it yourself, you're more than welcome. All of this try to present in a way that you can do it yourself. You can come up with us. But effectively, it's a number of quite explicit scenarios that have a lot of information underneath them. You don't have to choose all of them. I've suggested three on the right there that I find very useful. I'll talk about it very briefly, but it's looking at this relationship between policy responses and the likely cost to people and organizations with climate risk, and looking at those on a spectrum, which is why I do find this way of looking at it very, very useful. So on the left-hand side, you see this orderly transition, so this very early action, effectively managing largely to mitigate physical risk, as well as because it's being done very early in a relatively slow-ish fashion, you don't see as much aggressive change or correction to market valuations. On the right-hand side, you see what if people do nothing, and you see, frankly, very little transition risk because there is very little market change, but you do see very substantial changes to physical risk. And then at the top there, you see effectively what if everyone panics. So what if we start seeing very major climate events in, to be blunt, major economies, and how does the market respond to that, and how do policymakers respond to that? There's lots of ways in which you can then come to quantify. Oops. You can come to quantify this. Effectively, you can either look at carbon pricing. You can look at modeling of brown discount. We've got a paper on that. If you want to read it, please do. I still have some physical copies at my house. Let me know. I'll post you it. It's great. It's great bedtime reading. It'll put you right to sleep. And of course, looking at your concentrations of high carbon industries. So there's a nice little picture on the right there, but there's loads of ways of looking at that. So looking at hard to abate and high carbon intensity industries and how they can be modeled. Briefly, clustering. This is a really key point, particularly when it comes to the physical risk, but it's transition risk as well. of course, the PRA being the PRA, are very interested in what puts you guys at risk. Um, and what is likely, in their view, to put people at risk, and this is something they very much want to think about, it's not individual floods to individual homes. It would be, for example, an area like East Yorkshire and the Thames estuary, the Humber estuary, becoming heavily flooded, and organizations who are very, very heavily exposed to that, having, as Erin has pointed out, perhaps people coming and withdrawing large sums of money, as well as asset values dropping, possibly very dramatically, and looking effectively then at what happens there? What happens when we end up in that kind of scenario? What happens if we're overly clustered in these very high risk places? Have you got kind of controls and mitigation in place, which Erin and Steph will talk about shortly? Have you at least identified it and been able to think about it? Yeah.
Thanks. So, bringing this back to the risk assessment and trying to give you some practical hints and tips as to how to go about doing it and building it into some of these scenarios. So, as you'll see on the screen, there's an example of the starts of a risk assessment. This is not extensive by any means, and we have various other bits that we've started putting some thinking to. But if we kind of take emission thresholds as an example, that's a type of policy change that we might see happening as we go for that orderly sort of change, and we see government starting to put measures in. The impact of that could be that businesses or consumers are forced to pivot, that people take to their bikes instead of using cars, or we're moving to EVs, or whatever it might be. But there's likely to be a cost impact of that. So costs to the business as they buy new machinery, technology, whatever it might be, costs to consumers as they're having to spend out on new things, or find alternative modes of transport, or whatever it is. And all of those costs, of course, translate into potential increases in probabilities of default. Perhaps some businesses aren't able to stomach those costs. But equally, it might just mean that there's less disposable income, and that there's knock-on implications. And we're going to take some of these examples through over the next couple of slides. So I'm not going to say more about each one of these, but I think this is a really important first step, is to actually go through these categories and think about the subtypes and what the impact might be to your portfolio.
Fabulous. So we warned you we were going to talk about this, and here we are. So proportionality. Proportionality is, as you will see if you've read the policy statement, by far the biggest question that the PRA got from the original publication, and have tried quite hard to respond to. Without wishing to be critical of the regulator, I think they've responded in the way that they can, which is to say, please be as proportional as you can be, but also give us brilliant data that answers all of our questions. And then left it a little bit in your court. What we've tried to do here is suggest an approach to proportionality which helps you maybe put a little bit of meat on those bones, and helps maybe guide you in making decisions around how to create a proportional response for your organization. So we have a little bit here. So going from the left-hand side, where you've got organizations that are perhaps relatively small, relatively low impact on the financial system, potentially relatively low exposure to climate risk. On the right-hand side, you have your very large organizations and the expectations around them. So on the left-hand side, you've got then a model looking at, okay, physical risk. You can perhaps look at the risks that you already expect to be very material. Please do at least think about the others. But of course, we know that's things going to be like flooding, storm subsidence, coastal erosion, perhaps with a couple of others sprinkled in, depending on where exactly your portfolio is likely to be. There's plenty of open data available around those. It's quite challenging sometimes to work with, but it's certainly possible, either yourselves or with a partner. Of course, then you can do relatively straightforward translations through to EAL and existing approaches to ECL as well. I noticed there's a question I will come to, I promise, later. On the transition risk, to be honest, a lot of you guys probably have already got EPCs. There's a lot of issues with EPCs, but they are very, very useful for at least getting you started with looking at effectively an understanding of where your portfolio currently is. It won't help you very much in the movement of it, but it very much is a nice starting point, particularly for those who really haven't thought about transition risk at all so far. to look at which assets are most likely to be impacted by changes to carbon and therefore energy prices. As we move along, it's about looking really at evolving the level of detail and the level of capability. So looking at, for example, with physical risk, where you're seeing actual changes to value. So particularly looking at collateral value changes, real understandings of effectively how individual assets are impacted, and then on transition risk, again, coming back to like an understanding of how transition risk impacts on your sort of high concentrations of local or regional data, or particularly with sectors that you're involved in with commercial lending. If you're very heavily exposed to things like manufacture and agriculture in particular, having a closer understanding around those. And then on the right-hand side, then starting to look more at the integrations between things like EAL with loss given default and ECL and things like that, and as well as looking then at actually can you mitigate really some of that risk within existing portfolios, as well as really integrating it with things like more advanced data. So those of you, I know there's some people on this call who've got some really great green financing products. It's about looking at those not just as wonderful ways to help your borrowers, as very much you should, but also as ways to help you mitigate transition risk. So you can both harden against both physical and transition risk. So taking a more proactive approach. Oh, also, at that point, you should probably doing reverse stress testing. It's not as much an impact for smaller guys, but for larger organizations, I think it really is prudent. Hand back.
Okay, so to take this example and work it through a little bit further. So we were talking about the risk assessment, thinking about emissions thresholds, how those come into force and how consumers and businesses pivot. And that ultimately this causes changes in probabilities of default. It might also impact your lending volumes as affordability criteria. Affordability might get squeezed as people have less free cash. And this in turn might impact competition in the market. So you're suffering a bit of margin compression as everyone's trying to go after new loan assets. In terms of then the data that you need to start building this into some climate scenario analysis, it might be that you want to look at regional data on where employers are that rely on that have high carbon emissions, to think about, well, actually, majority of emissions are in the Northwest, Humber, Midlands, wherever it might be. Can we use that to think about, well, we're going to increase our PDs on our, on a broad brush approach for our book in these areas? And I think to link it back to that proportionality piece, you might be thinking about, well, let's do it on regions and broad percentages. If you're relatively low risk or relatively small in size, low impact. But actually, as time goes by, or if you're higher risk and higher impact, you might be thinking, well, actually, can we collect data amongst about individual employers for our customers, so we can have a better, more granular understanding around the employment of our customers and build that into our PD models. Once you've gone through this scenario analysis and you've managed to come up with something that helps you think about how you might see things unfolding under different events, it's about then using that information to set limits. Do you want to limit the amount of lending that you do in a certain area, or to types of individuals or businesses that are in particular industries or sectors? Is it that you need to think about your product type and you need to change? So, for example, lots of people have big development finance portfolios. If you think that there's going to be perhaps a particular squeeze on them with costs of materials and perhaps supply chain issues, maybe it will push you to pivot and think about alternative products. So it's really taking that information and linking it through. Now, given where we are on time, I'm not going to talk about the other example, but we've got another one on the other side, which is just really sort of following through on that physical risks and how that might do things like impact surrounding areas and drive HPI changes in a whole area, even though there might not be an impact for a particular individual property.
Great. I'll try and be quick on these slides as well. But I think, what we've sort of covered so far has mostly been around sort of your risk management in the longer term, thinking about longer term impacts, and then those sort of risk controls that Steph mentioned are more sort of on your longer term. But you've got a document like the ICAP where you've got to think about, setting Pillar 2A, and that's for sort of risks that could crystallize in the next year. Pillar 2B, scenarios up to sort of 5 years in length. So what could you sort of think about, and how can you sort of translate that, for your ICAP? Got some examples on the next slide of just the sort of things we've been seeing in case this is helpful. And I'll just pull out, a few examples. But, on Pillar 2A credit risk, you could, I suppose what you're assuming is like a shock. So you could assume, for example, all of a sudden there's a government announcement, and mandated EPC ratings change, and all of a sudden there's a big, price shock to that buy-to-let portfolio. That announcement could happen in a year, so that sort of price shock could happen in a year, and it would affect sort of LGDs, on sort of expected losses for that year, and it's something that you could price for that 1 year. Similarly, on Pillar 2A operational risk, there could be a flood or an outage. That's something that could happen in a year, so that's something you could bring out in your ICAP. And on Pillar 2B, we've seen examples of people building this into their stress testing as well. So some people use, the CBERS or another scenario, and use that as one of the many scenarios, including the macroeconomic and idiosyncratic, that they test in the ICAP. We've also seen examples of people maybe running their macro scenario, but also including an idiosyncratic climate-based event as an extra layer on top of that as well. And that's another way to think about it. Coming on to liquidity, and sort of the ILAP. And we've just got some thoughts here of what you might want to think about. I mean, there's a number of different time frames you want to think about with respect to liquidity. Like, there's intraday, 30-day, 3-month. And really what you want to be thinking about here are, what could hit, within those time frames, and how could it play out. So, we talk about how a climate event like a flood could affect customers, particularly within 30 days. You could see them wanting to start withdrawing deposits and draw down on their lines of credit, much quicker. And on the sort of the transitional risk side, you might want to think about, does the firm have a sectoral or sort of geographic concentration that might be exposed to sort of climate-related economic decline in a way that it impacts sort of funding, like either, deposits, or there might be sort of liquidity shocks that come in the future. Do you have sort of climate sensitive, are your assets in climate sensitive sectors? And there could be increased repo haircuts on such assets. So it's really just sort of thinking about how could it impact on, or how could there be a shock on what needs to be drawn down, or how it could also impact your funding plan in the longer term. And to sort of summarize with the last slide, how you sort of get to 3rd of June. And then 3rd of June isn't the be all and end all. Like, as I sort of said earlier, there's an ongoing expectation to sort of keep doing the step 1 and the step 2. But you do have to have sort of a gap analysis and a credible plan by the 3rd of June. So what we think is, if you haven't already, do some internal workshops with different areas around the business and identify potential risks. Think outside of the box. What could happen in markets, geographical areas in the next 20, 30 years? But then also what sort of shocks could happen in the next 1 to 5 years that could be relevant to the ICAP. And then identify what information you already have on these risks. What information do you currently have about borrowers and so forth? Whether it's possible to conduct stress analysis with that information, or what would be beneficial to know on top of that? And is there a way you can get that information, like through a third party, or by starting to collect data now, so you'll have something maybe in 5 or 10 years? Think about what kind of scenarios you're sort of likely to sort of run. What are going to be your material risks? What are going to have the most significant financial impact? And think about how you're going to run those scenarios and what capability you might need to build up. And then how you're going to respond to the information from the scenario analysis. So are there going to be risks that are going to require monitoring, mitigation? What kind of mitigation? Stuff that Steph touched on, like limits on concentration, additional checks in underwriting, a greater understanding of your third-party suppliers, and then come up with a plan for how you're going to develop those. And identify where you might need some potential assurance. How is the board going to get comfortable that the firm's in the right place on this? How often is the analysis going to be reviewed and updated? And then so do document all of this by the 3rd of June and then implement. And don't just wait till the 3rd of June to start implementing. Implement what you can now, and continue to implement. So I think that brings us to the end of what we wanted to present to you. I know we're right on time. If we wanted to take a few extra minutes for questions, I think most of us can probably hang around if anyone has any questions.